This is Alan Gassman,
And I'm here with David Dummy.
and we're going to talk about estate tax planning. If you tuned in early, you saw a very nice video of a very nice memory of a very nice dolphin and a good friend of many people in Clearwater, Florida, and that was Winter the Dolphin. And the movie The Dolphin's Tale and The Dolphin's Tale Part 2 were very meaningful, great movies, and based upon a lot of truth. This little almost baby dolphin washed up on the beaches was expected to not survive, was able to survive, and then the prosthetic tail was what they call the shtick. You know, if you're going to be a successful professional of any kind and really stand out in your field, you've got to have what they call in Yiddish the shtick. And when Winter the Dolphin got that tail put on her as an amputee, she became a great symbol for children who are amputees. So if you watch the web, if you go to YouTube and you look at Winter the Dolphin, and you see the children who were amputees, you know, looking up to her, she was a smart animal. She knew something was going on. Sort of a delight to watch her play. So we miss Winter the Dolphin.
I do too. But
Okay, well, I guess I got some work to do here. I appreciate all the questions I've been getting and the discussions I've been having offline with people. I'm going to open my question box here. I'm going to not forget to be able to answer questions. And this is part 3, but of course we've not done part 2 yet. See, I didn't have part 2 ready to go, but I had part 3 ready. So I thought we'd go to part 3, and then some other time we'll handle part 2. Once again, Winter the Dolphin, the Clearwater Marine Science Center, my friends there, you have our condolences. I know you loved Winter more than your own children, and knowing your children, I understand why. This presentation does not qualify for continuing education credit. It's simply not good enough. There is a questions panel, and if you click on the questions panel, you can open it, and then you can you can ask the question. If I know the answer, I'll answer it. If I don't know the answer, I'll pretend not to see it. Please do go to our YouTube library, Alan Gassman YouTube, and you will find all of our estate tax planning Saturday programs across the front, the top, and then you'll find a lot of charitable programs in the second screen. So, and by the way, again, I commend my friend Sandy Glazier, who did a really nice 17-minute talk on all the different tax proposals that would affect estate planning, which, hooray, got nowhere. So it's really nice that the estate tax exemption not only is 11.7 million right now, but it's going to 12,600,000 in just a few days because the year is almost over. And the $15,000 annual gift exclusion, that is, goes to $16,000. So we will talk about that. Here on page 14, just to bring everybody down to the same playing field, we a very happy married couple. The less happy spouse is the one who dies first, reportedly, and can leave up to $11,700,000 worth of assets into a bypass trust because it bypasses the estate tax. So if the first dying spouse has 15 million of assets and dies, 11.7 million goes into the bypass trust, can benefit the surviving spouse, never subject to estate tax at the surviving spouse's level or the level of the children or grandchildren. If you put this trust in South Dakota, it can go 999 years. Florida, only 360 years. Better than Florida's Nevada because you get 365 years. And those 5 years could make a pretty big difference. Now, to the far left, life insurance. If you own life insurance, or you have what's called an incident of ownership, which means you have any sort of control over it or benefit from it, then it's in your estate for estate tax purposes. But if you give it to an irrevocable life insurance trust, which your spouse could be the trustee of, then if it's in there more than 3 years before you die, or it's purchased fresh under that trust, or the trust buys the policy, then on your death, no estate tax, even though it's held for your spouse. Keeping in mind that in 2026, this exemption is expected to come down to half, because that's what the law absolutely says. If you're going to be over $6 million of assets in 2026 and you have life insurance, it's not a bad idea to put a life insurance trust in place. The new proposed legislation, which did not come out, which will not go forward because Senator Sinema won't vote for it. I know she's the favorite of many people on this webinar, but if you're still going to be over the 6 million, you have to be giving some thought to doing some of this planning. And for those of you who are new to this webinar series, first, you have my condolences. I'm sorry you don't have anything better to do. But here you have this spreadsheet that I'll be glad to send you if you just email me with an RE line spreadsheet. And this is a happy married couple, not because they love each other, but because they have a $10 million net worth that's increasing by 7% per year, which is a pretty nice gig, I think. And you can adjust here on the right. So let's say that really they're gonna have an 8% rate of return, and let's say they start with a $13 million net worth. See, all I have to do is click on the arrows, and let's say that they're saving $100,000 a year for 20 years, and then they're going to retire. Well, they don't feel like they're estate taxable right now, and they're actually not. But it only is going to take them 10 years to get to 27 million. And by then, the estate tax exemption will be 29 million if it doesn't come down, as you see here in green. But if it comes down to half in 2026, then they're going to have a pretty big estate tax. So you can use these arrows, speak with your significant other and decide if you're going to save more or less. That should be a decision, not an accident. The number of years you're going to save, we can't really predict. But as you can see here, here's an estate tax. They're only at 13 million. They don't think there's anything to worry about. And suddenly in year 20, their estate tax is $9 million. So I've got one of these spreadsheets for a single person. If you're lonely, then you have more time to use the spreadsheet. So that's the single person. And just so you know that they are there, I'll move this over and back to our amazing slideshow. So here is a new client that I met with this week, and we talked about two different things that he could do. His net worth is over 10 million, but he's not gung-ho on estate tax planning. He may leave a lot to charity. He may leave a lot to his spouse, but he does have a daughter and a granddaughter, and he wants to make sure that they get benefited come heck or high water, as he put it. So all he has to do here is place $3 million worth of assets under a limited liability company, and then set up an irrevocable trust. Now, this irrevocable trust, the real reason for the irrevocable trust is to make darn sure that the one daughter and the one granddaughter are going to inherit. No matter what happens to him, creditor situations, changes of his mind, he wants to leave it all to his new wife. He doesn't want that to happen. He would like for this daughter and granddaughter to get at least $3 million or hopefully more. So he puts $3 million in the LLC. He waits 30 days or so. That gives him time to pay my first invoice. Then he transfers the 99% non-voting member interest to this irrevocable trust. his daughter could be the trustee of the trust, and he reports that as a gift. He'll hire a valuation firm. They'll take a long time to do a valuation report because they're so busy right now. And he'll find that he's only used $2 million of his estate tax exemption. So now if he were to die at the end of this year or the end of next year, instead of $12,600,000, his exemption is going to be $11,600,000, but his estate is going to be smaller by $3 million. And if he lives 10 years, and I think he will, then the LLC might be worth $6 million that he'll have out of his estate for estate tax purposes, but he's only used $2 million of his exemption. And again, that trust is locked in for that particular daughter and that particular grandchild. Now, the trust can also provide, though, that the trustee has the discretion to make distributions to whoever he's married to. So if he changes his mind about the arrangement and says, you know, I'd like to get some money out of there. I'd like this trust to pay half of my living expenses. I haven't been to Europe for a while. Go ahead and get her a business class seat. Don't make her sit in coach like normal. And pay for some food and pay for half our taxes. Professor Hesh says that that's fine. So then there can be trust protectors, his brother and his best friend from New York. You're allowed to have a best friend from New York. They could decide to cut the daughter out and let it all go to the granddaughter if the daughter is not polite. So you've got the flexibility there. Now the rest of his estate, which maybe will be 10 to 12 million, he can decide later and change his mind as he goes along. So this was the first slide, the first explanation I promised him. Now here's the second explanation that I promised him, and that was I'm suggesting that he consider, you see the lawyer language there? I'm suggesting that he consider, I didn't say I suggesting, but he should consider, and then you go to the, but if it were me, I would. That works well. But anyway, he puts $9 million worth of assets into the LLC, and he takes back a 99% non-voting interest. Now, a lot of people think NV stands for North Virginia, but actually he's not from North Virginia. So NV stands for non-voting, and you shouldn't have a lot of NV anyway. And then the V is the 1% voting. That also stands for victory. Happy Veterans Day. Thank you very much if you served in the military. So you've got 1% voting, 99% non-voting, $9 million in the LLC, wait 30 days so he has time to pay my invoice. We set up an irrevocable trust for his spouse and his descendants, all of them. It's a little bit trickier, this one, because he's going to have to make at least a tentative decision as to what portion he wants to go to the spouse if they're still married, and what portion he wants to go to that favored daughter. I won't say favored, deserving daughter, and what portion he wants to have go to that deserving grandchild. And by the way, all grandchildren are deserving, whether they're really deserving or not, or at least that's what I'm learning. So he makes a seed capital gift of $600,000. Now, if he's a marijuana grower, he could put seeds in there, but otherwise, or if he's a farmer, but actually it's best not to put Q-tips either, but what you put in there is money, stocks or bonds, and that way it's easy to value on the gift tax return. So now what I want him to do is I want him to sell that 99% non-voting member interest in the LLC to that irrevocable trust in exchange for a $6 million note, which will bear interest for 9 years at 1.04% a year. So he's only going to be getting $60,000 a year from that note. He's going to be living from his IRA and Social Security, which I know pay plenty. And now I've reduced his estate by $3 million. Multiply that by a 40% estate tax. I've reduced his estate by $1 million 2, when the assets are worth 18 million in the LLC, the promissory note's still going to be 6 million. The other thing that's important to explain is that this is what's called an intentionally defective grantor trust, an IDGT. It's not a disease, it's a condition you get when you set up a trust and you reserve the power to replace trust assets with assets of equal value. When you do that, and by the way, clients, and it's in section 8.21 of your trust agreement, you do that, the trust is disregarded for income tax purposes. You pay no income tax on the sale. You pay no income tax on the interest you earn, but the dividends, interest, and capital gains under the LLC go on your personal return. That's good news because that reduces your estate. Remember, we want to reduce your estate. Keep forgetting that. And it allows the irrevocable trust to increase in value. Now, why did I suggest 9 million? Well, because it's divisible by 3. Because I like to describe this, fellow advisors, if you use a 33 1/3% discount and you start with a number divisible by 3, I could have done 12 million, I could have done 6 million, but my gosh, if I had done 8 million, I don't know what 66% of 8 million is. I'd have to ask Alexa. It takes Alexa a while to answer. So just a trick for the trade. That's one of the reasons I'm a little bit disappointed that the gift tax exemption went to 16,000 a year, because you can't divide that by 3 when you talk about discounting. So then what happens 10 years later? See, 10 years after was a band, and if you email me with the next minute and tell me the greatest hit song of the band 10 years after, I will send you, I'm not sure what I'll send you. It depends on how many I have, but I'll send you one of my books. I'll send you the book on ATF weapons. So if you want to learn what to do with your automatic weapon or your silencer or suppressor, you'll know all about it. All right. Well, 5 years after the installment sale, in case this person doesn't have a long life expectancy, you've got 13,500,000 in the trust if you are using 7.2% rate of return, which doubles the assets every year. And my gosh, you have, what is out of your estate? 13,500,000 minus 600, 7,500,000 plus the 700,000. So you have 8,200,000 out of your estate using a fairly, really simple planning arrangement. So I should have like a rabbit come out of a hat or something. That was just too easy. Now, Brandon and I have been working on another plan, and unfortunately for the client, but fortunately for the client's descendants, she has a relatively short life expectancy. So when you have a relatively short life expectancy, as long as you can be expected to live more than 1 year at the time you enter into the arrangement, or you actually live at least 18 months, that you can use the private annuity rules that apply to an installment sale and use a self-canceling installment note so that the note vanishes on death. I think I just did a terrible job of explaining that. Let me explain it again. If I if I sell $1 million worth of assets, in fact, let's go back here because we can talk about this client. Instead of a $6 million note for 9 years paying interest at 1.04%, the note is in your estate when you die. How would you feel about an 8% note would vanish on your death? Now, if you can promise me that you will die within the 9 years, I can tell you that the 8% interest versus 1% interest, that's 7% times 6 million. That's 42,000 a year times 9 years. That's 42 times 9. That's what, 36 something. That's a lot of extra payments. If you live past the 9 years, it's backfired. But if you'll do us a favor and die during the 9 years, then your estate will not include the note. But the IRS says in order to use the standard tables for determining how the interest rate is on how much the interest rate is on the note, you have to be of reasonable health. And if you're of worse health than the average person, then giving the $6 million self-canceling note is a gift. Slightly disagree. I could be wrong. It's a risk when you do these notes. We have a way to alleviate the risk or to reduce the risk of a gift tax problem by using what we call a SCRAT, S-C-G-R-A-T. You can read about that. You search Gassman SCRAT. But in any event, this person that we came back to with the IRA, here's what she has. And Brandon ran these numbers, and we're going to review them next week as well. Her IRA is worth $7.3 million. She's 78 years old. Her non-IRA assets, which are stuck in a qualified terminal interest trust, are worth $2.6 million. So when you run a 6% rate of return, which is what has been her average, and you're stuck with the IRA being subject to estate tax, and then after that, when you pull it out, it's subject to income tax, but at a lower bracket, because if you pay estate tax on an IRA, then when you withdraw it, you get what's called a 691C deduction. But in any event, she's looking at an estate tax of $6 million. And her advisors understandably said there's nothing you can do because you don't want to pull money out of the IRA and pay income tax. Now, you could convert the IRA to a Roth and pay the income tax, which would reduce the estate, and that might be a better thing to do. But because of her health, we decided to pull out enough of the IRA, pay the income tax, and put the rest of what she pulls out of the IRA into an LLC and sell the 99% North Virginia interest in the LLC to the trust in exchange for the note. And then when she dies, the note's off the table and she is out of estate tax world. And at the same time, she's out of this world, unfortunately, but she'll be with Winter the Dolphin, which isn't a bad gig. So these are Brandon's numbers on these scenarios. So next week, he talks about the second one here, because the first one, we show you have to show not only what happens up to date of death, but then what happens in the years after death and what the net total is for everybody. And they end up with 17 million in year 25. But if she'll go ahead and liquidate the IRA, they'll end up with a lot more in year 25. They'll end up with 18 million for, which is not a lot more than 17 million, but I think it feels a lot better when the estate tax is reduced. And the way we're doing it, though, there'll be no estate tax, but these are the numbers that Brandon ran, and as always, we've run a lot of scenarios, and then there's even a graph. So, what could be better than a graph? So I talked to you about our estate tax chart. One thing that Jerry Hesh taught me, and experience has taught me, is you can't just instinctively guess at the numbers until you run this on a spreadsheet. You can't really be sure what you're doing for the client is going to work. I mean, certain things are definitely going to work if values go up. Back here, a lot of professionals keep asking me, Alan, you taught the Biden two-step, which was put a small seed capital gift into the irrevocable trust and then sell the assets for a note. But why wouldn't you forgive the note and use $6 million worth of the client's exemption? Well, before we knew the exemption was not going to go away, we were doing this thinking that we would forgive the note before the exemption went away. But here is one reason to keep the note in place, fellow planners. What if 2006 happens again, 2007, 2008, 2009, and the stock market crashes? and the 9 million of assets is only worth 6 million. And the client says, you had me use 6 million of my exemption, and there is no discount here. I sure wish I could have gifted this after the values went down, but you locked me into a $6 million gift. Well, what did Alan do? Alan took the equivalent situation. He used 600,000, not 6 million. Now the LLC is worth 6 million. The client gets paid back 6 million. We eliminate the note. The irrevocable trust still has 600,000. And what does the client do? He sets up a new LLC. He puts the 4 million in, he puts the 6 million in the new LLC, and then he does another sale to the same trust for a 4 million note. So if the market tanks, I've gotten $2 million out of the client's estate. And if the client dies after using 6 million for the note gift, but instead he dies owning a 9-year note and there's 5 years left on the note, I'm not reporting that note at 6 million on the Form 706 estate tax return. I'm going to report that note at 5 million or whatever the valuation firm comes up with. So I do like to keep these notes in place for those reasons. And then for another reason, what if he has a falling out with his children or his spouse? Could you imagine that hardly ever happens? Then he can say, give me my note back, Jack. That's an important reason to have a trustee named Jack. So that's our discussion so far. Let's see what else we have here. We have there's the rule of 72. So if you're going to be an estate planner, you always want to use 7.2% so that it doubles every 10 years, so you can remember that. Otherwise, it'll double in different arenas. Something I wanted to just mention, because it's come up in a lot of conversations, is it's much better to save earlier rather than later. Show this chart to your clients. Dr. A starts investing $100,000 a year at age 35. Dr. B doesn't start until age 40 with the same growth rate, which was, I believe we used 6%. Dr. B, to catch up, has to invest $143,000 a year instead of $100 a year for like 25 years before he can even catch up. So save early. You know, don't have the vacation home until you're ready to retire, or at least you have the financial means to retire. So what else can we do with the promissory note? I remember I was in 3rd or 4th grade. What is a preposition? It's anything a squirrel can do to a tree. Anything G or PG rated that a squirrel can do to a tree, that is the definition of a preposition. So you can do a short-term note with a very low interest rate, a 9-year note with a higher rate, a note for the life expectancy of the client at a higher rate, a skin for a 73-year-old, a 12-year-old skin for about 6.6%, or a level year annual annuity for $90,000 a year per million. So on a $6 million note, 6 million times 90, 540,000 a year, you get 9 million of assets out of your estate by using a discount and a 6% note. And then you get 540,000 a year, which you happily spend until the day you die. And then when you die, there's no estate tax. We're running one now for a client who is, I believe, 73. He's in good health, and he wants to spend $1 million a year. But at age 83, he's going to go down to 500,000 a year. That's his plan, and that's probably realistic. So we were able to back into how much in assets he would sell under a discounted situation in exchange for a private annuity payable by his very well-funded trust. Because the trust has to be very well-funded to do a private annuity. So now he's going to get his $1 million a year for 10 years, then his $500,000 a year evermore. And then on his death, there's going to be no estate tax because the annuity vanishes and we're able to keep him under the estate tax exemption. So what Professor Doug Miller told us in a estate tax law class at University of Florida in 1983, first day, first 10 minutes, the estate tax is a voluntary tax. Find your way around it. Give the rest to charity or to your spouse. Don't pay it if you don't want to pay it. That would be a very good goal. Now, what we find over and over again is that people have gone to very good estate tax planners and have handled their home in a qualified personal residence trust. They have handled their stocks and bonds in an LLC sale, but they have left their business company out of the plan. And quite frankly, the main reason we see for that is that the advisors had not worked with S corporations or C corporations and grantor retained annuity trusts and defective grantor trusts and installment sales. And sometimes this is a professional corporation and the advisors are under the impression that you can't sell or have part of your professional corporation owned by an irrevocable trust. And that is commonly wrong. For example, in the state of Florida, a medical practice not owned by a doctor or his spouse or children has to sign up under the Clinic Act, and there's a lot of extra surveillance and paperwork involved. But we have been successful in having the Agency for Healthcare Administration consent or say, yeah, that's okay, to an arrangement where the irrevocable trust owns a land trust, and the land trust owns the stock of the S corporation, and the doctor's the trustee of the land trust. So you'd have the irrevocable trust here for spouse and descendants, and then you would have the doctor as the trustee of a revocable trust owned by the irrevocable trust, and then the doctor transfers 40% of his ownership in the S corporation to the trust system. Now, the annual K1 income of this S corporation is $10 million, and the estimated value at 6 times earnings is $60 million. So 40% of $60 million is $24 million, which is divisible by 3, and therefore worth $18 million after a 33 1/3% discount. Now, in the real world, the discount will be more or less than that, but it will not be moralless. It will have scruples. It will just be more or less. So $18 million now owed to this client at 1% interest, $180,000 a year, and the trust is getting $4 million a year, and the client is paying the tax on it. The client makes a $2 million seed capital gift. The trust now has $2 million plus $4 million after 5 years. The trust has $20 million. It's made $900,000 of note payments, so it has $19,100,000. Wow! Plus the $2 million seed capital gift, and the stock, if it grows in value, is worth $24 million. The trust owes an $18 million note on a $2 million gift. I have taken $25 million out of this client's estate. So, and not only that, but the client has paid the income on the gift, so I've reduced, on the annual income. That's why she kept 60% ownership. So that's after 5 years. After 10 years, I've reduced her estate by $44 million. Now, I am still not as popular as the hairdresser or the landscaper or the pool person, But $44 million times 40% makes it worthwhile to learn how to do this, makes it worthwhile to spend the 10 grand it takes to get the valuation report on the S corporation. If this is a professional in a state that doesn't allow ownership, go ahead and set up a management company and do an irrevocable 20-year management agreement using arm's length terms, the same exact way that the practice management companies do this all over the country. You can use their economic model. You can value it in the same way. You can get the same result. And then the management company can be partly owned by 678 trusts for the grandchildren and get Section 199A 20% deductions on the income. So this is a good tool for the S corporation. All right, now I want to show you something else. And again, this goes to the math. I've done this weeks ago, but you probably don't remember. Married couple with $4 million home growing at 3.25%, and then $48 million of investments, which are going to grow at 5.5%. They save $300,000. The husband will die in 6 years. The wife will die in 15 years. The estate tax, if they do no planning, will be $42 million. Well, when the husband dies, they could fund a credit shelter trust, which would not be subject to estate tax 15 years later, and that will save about $2 million or $1.7 million in estate tax if you look at the second thing there. Well, the client wants to make an $11 million gift, and quite honestly, that's all he is psychologically prepared to do. I explain LLCs, I explain installment sales, I stand on my head, I jump and shout, I pretend to agree with him on everything except politics, and he just wants to make the $11 million gift. We make the $11 million gift, and now the estate tax is down to $34 million because the growth on the $11 million will pass estate tax free. Well, what if I could just get him to put $21 million in that trust and take back a $10 million note at 1% interest? And the rate would allow 1% back when we ran these numbers. That would save an additional $4 million of estate tax, and psychologically he could understand that and he could do that. But to protect myself, I had to also show him other alternatives that he was passing up. For example, he could have put $15 million in the LLC, and he could have sold a non-voting member interest for a $10 million note, and that, instead of the $11 million gift, he could have put $11 million in the trust and then a $10 million note, but he could have used a $15 million LLC for the sale. Then there would be additional estate tax savings of $4,400,000. Now that does offset the cost of an LLC and a valuation report by about 100 times. So that would probably be a good investment. But what if I could have gotten him to put $32 million in the LLC and take back a $21 million note? He could easily live on 1% of $21 million a year, plus there were assets left out of the arrangement, as you can see. And he wouldn't do this, but the additional estate tax savings would have been $9,600,000. That would have bought his grandchildren a lot of really nice sports cars and airplanes and mansions, but it didn't work. He didn't go for it. But then here is the chart. So the moral of the story is, if he had just put thing dividable by 3, if he had just put $6 million in the LLC and sold it for a $22 million note and put $2.2 million in the gifting trust instead of $11 million, he would have had a much better result. So I'm getting a lot of questions about qualified personal residence trusts. People are accusing me of glossing over them. Do not gloss over the qualified personal residence trust. So a qualified personal residence trust is an irrevocable trust. It is specifically authorized by the Internal Revenue Code under Code Section 2702. And what that code section says is that if you put your primary residence or one other residence, it needs to be a residence. It's not a rental property. It's one of your residences, vacation home at the time you do it, plus adjoining property reasonably to accommodate the home, not 1,000 acres, but maybe 30 acres if you're in a farming community. You put that in the trust and you retain the right to live on the property or use it or get the money from the rent if you convert it to rental for a term of years. And the longer the term, the less the value of the note. So I am 62 years old. I'm pretty sure I'll be here at age 77 in 15 years, which is divisible by 3. I'll probably still be giving this show on Saturdays. Make sure you tune in. So I could go ahead and put my half of our home, and by the way, my half is the guest room and the family room and the backyard. Marcia's part of the home is everything else. But I can put my half of the home into a qualified personal residence trust. I'm allowed to live in it for 15 years rent-free. And if our home is worth $900,000 and my half is worth $450,000, but I take a 15% discount, I report that as a $350,000 gift or $370,000 gift. But because I get to live there 10 years, it's really only a $200,000 gift. So I've gotten half of the home out of my estate. I report a $200,000 gift, but in 15 years, if the home is worth $2 million, I have $1 million out of my estate, and there's almost no formalities involved. So we've got a spreadsheet for it. For those of you who are new or who keep falling asleep during the talk, this is a modified spreadsheet that Brandon put together to show the income tax situation as well. So here I am with $1 million. Let's say the home is worth $1.9 million, and the gift element, the exemption used, is $961,000. And they have elected to have an 8-year rent-free, and after 8 years, they're going to start paying rent at based upon 8% of the value of the home each year. So in year 10 here, the home is worth almost $2.5 million. They've paid rent so that the trust has $418,000, and then they die, which is sad, very, very sad. And the estate tax savings is the difference between $2.8 million and $961,000. They've saved $774,000 worth of estate tax. The children sell the home. They have to pay a larger capital gains tax than the parents would have. If the parents had died with the home, there might not have been a capital gains tax, but because of this, the capital gains tax comes out to as much as somewhere between $240,000 to $340,000. Now, Brandon and I believe that when a trust is disregarded for income tax purposes and the grantor dies, that the income tax basis of the assets of that trust come up to fair market value because the trust was disregarded for income tax purposes. And we are working right now on a letter of guidance for a client who had a big event, meaning grandma died, and a lot of assets should get a step up in basis in our view, by our view. I don't use the word opinion because that has a special meaning in law. It means it's easier to sue the law firm that gave you the letter. But by our view, there should be a step up in basis in that trust. And we are not aware of any authority to the contrary. Now, I believe that most of our well-versed colleagues believe to the contrary, but I will tell you this, if I'm a CPA filing an income tax return, I am certainly going to take that step up as opposed to having those clients come back and sue me years later if and when it turns out that there is a step up. And one recent event which causes us to believe that there are two recent events which cause us to believe that you should claim the step up. The first one was the Bernie Sanders bill, which was well written by good governmental related tax drafters, said there's no step up when the grantor of a defective grantor trust dies. Well, that means they must think that there is a step up. Secondly, the IRS just put the step up on their no ruling list. And putting something on the no ruling list usually means we don't know which way to rule. So the IRS doesn't seem sure. There is a foreign related IRS opinion that there is a step up, but that may have been issued accidentally. Some of our friends who are much smarter than we are think that there is a step up. So step right up and use this spreadsheet. Here you can increase or decrease the value of the home. You can go to Tiger Tables or Number Cruncher or whatever you use to find out what the use of the exemption is, and then set it using this arrow. Figure out what the rent percentage should be, figure out how fast the home is growing in value, and then the length of years of the Cupid. So I thank Grace, the law clerk, for getting her boyfriend to set this chart up for us. And I'm sorry that you went to work for a personal injury firm. It broke my heart. Okay. Let me go ahead and answer some questions here. There aren't as many as usual. Okay. What was the value of Winter the Dolphin? Well, my friend Frank Catlett of Triggs Catlett Appraisals in Tampa has appraised many dolphins for SeaWorld. And a dolphin over age 10 who cannot have babies or cause babies is worth about $250,000 last I knew. But a young mare, a young girl dolphin who can have a lot of babies could be worth $1.5 million or more. Winter the dolphin, thank heaven that there's no estate tax on dolphins, because I'm sure the Clearwater Marine Science Center, I hope they're getting royalties, and I'm glad they don't tax dolphins. Someday, dolphins will probably be free and have property rights once you can finally talk to them. Did you know that a dolphin can go into a cavern and know the dimensions of the cavern, come out of the cavern, and tell another dolphin the dimensions of the cavern? So then the second dolphin, who can be blindfolded, can go and navigate in that cavern without hitting a wall. So there is a lot of intelligence to the dolphin. And if you've ever read the books by Douglas Adams, he goes into great detail about the intelligence of dolphins and how frustrated they are with humans. Okay, this is from Robert. Do you have particular recorded sessions that explain value and use of charitable remainder trusts? Yes, on the website, there is a St. Petersburg College presentation by Jerry Hesh, which talks about charitable remainder trusts, and he does a great job. Is there any way to obtain the PDF slides for your YouTube presentations? Yes, David, all you have to do is ask. Just send us an email. Kelsey will be back on Tuesday, and she'll be glad to provide that with you. Okay, the 2022 exemption is 12.06 million, not 12.6 million. Okay, I stand corrected. I think you're right. So it's going to be $12,060,000, not $12,600,000. Thank you, Craig. I'm going to send you the gun book. Okay, David, I meant slides from previous presentations on YouTube. Yes, we'll be glad to send those to you. Okay, in your estate tax software, the Estate View software, which is the best software ever used by the questioner, I kind of am assuming that. Can the exemption amount be increased each year for inflation, or does it stay the same? Stuart, that's a great question. The exemption amount does increase by the CPI amount that you choose on the bottom left-hand side of the Estate View software. And by the way, I know that Estate View software is far from perfect, but it's still very useful. Kelsey's husband is a software programmer, and he is working on a new version. So there's 100 things I would like to do with this software, but it's very expensive to change things. But if you have suggestions, we are all ears for them, and appreciate that question. Okay. Is there a house value that should be used as a benchmark for using the Florida Community Property Trust? Not sure what you mean by that, Tom. If you can clarify it, I'll be more than glad to talk about it. But a community property trust is a new Florida law. It took effect in August, I believe, August 1st. And it allows a married couple anywhere in the United States or in any territory to place their assets with a Florida trustee or co-trustee in a specially drafted trust. And then when one spouse dies, all the assets of that trust should, we hope, get a new income tax basis equal to fair market value. So what happens today is Marcia and I own, say, a $10 million portfolio that cost us $4 million, and we own it jointly. I die, she's very sad for a couple of days. Then she says, what's the capital gains situation? Well, the capital gains situation is you only got half a step up. So you're going to still pay half of the capital gains tax you would have paid if you had waited for the second death. But instead, if Alan and Marcia had put that into a community property trust and Alan died, less sadness, maybe only sad for a day instead of 2 days, because now she can diversify by selling those assets because they got a $10 million basis on that date of death. Now, you know, I keep forgetting in some conversations to mention that as long as you're doing an irrevocable trust for your beloved spouse and descendants, go ahead and put that short life expectancy father-in-law, mother-in-law, parent, aunt, uncle in the trust as a discretionary beneficiary, and give them the power to appoint trust assets to creditors of their estate, but only with the consent of your best friend from high school, your best friend from college, your drug dealer from graduate school. And then when that person dies, the assets of the trust are considered as owned by them, and you get a new step up. So, you know, it's a little bit inconvenient to have an elderly person that you're helping to support and you're, you know, helping them with their stuff, but let them give you back the gift of a stepped up income tax basis on the first death. So I've got materials here on the step ups, and the other alternative for the step up is the Just Trust. Now, the Just Trust, I like it. I'm biased because I helped invent it. It stands for Joint Exempt Step Up Trust. And what it does is it allows the married couple to, it's Peggy the Dolphin. Hi, Peggy. That's the 5-minute reminder? Oh, okay. Thank you very much. Then we'll go swimming. Thank you. Thank you. And I'm so sorry about winter. I know, you're sad. I'd be sad too. But at least we could plan your estate. Okay, so now what about the Jest Trust? What do I like about the Jest Trust, besides the fact that I helped invent it, is that it's complicated. I like anything complicated, but here's what's better. I could put assets in this joint trust, and let's say spouse one is a neurosurgeon and spouse two is a homemaker. And I don't really want to put half the assets in the neurosurgeon's name or in a trust that the neurosurgeon's creditors can get hold of much. And I want to step up on the first death, and I want full funding of a credit shelter trust on the first death. This could be a relatively young couple. They only have $10 million to put into the credit shelter trust. I don't know who's going to die first. And they have a large income because of the neurosurgeon. So I could use the Jest Trust. Here's how I do it. I put the 10 million of investments in the Jest Trust. I say that the shares are 5% held by the neurosurgeon, 95% held by the homemaker. I provide that the first dying spouse will have a power to appoint the trust assets to creditors of his or her estate, but only with the consent of their best friends from high school, who are not required to act in a fiduciary manner. So one of them dies, the amount that can pass estate tax-free goes into Credit Shelter Trust A for the health, education, and maintenance of the surviving spouse. If they're over the exemption, then there's these other fancy trusts that they go into. I like it better than the Community Property Trust because with the Community Property Trust, creditors of either spouse can reach a lot of the assets of the Community Property Trust, but not of the Joint Exempt Step-Up Trust. The Joint Exempt Step-Up Trust is much more difficult to draft, but the forms are available, and I think a lot more people are using the Jest and will continue to use the Jest now that the exemption is higher, so that you can get more in the Credit Shelter Trust on the first death and try and at least have the step up. So there are really good articles questioning issues that the IRS may bring up if they ever review the Jest. And then here, I've got information on Ed Morrow's optimal basis increase trust. And this would be an irrevocable trust or possibly a revocable trust where you give great grandma that power to appoint trust assets to creditors of her estate. Well, I didn't get to the charitable remainder trust, but I had a question on charitable remainder trusts. So I will make sure to cover charitable remainder trusts next week. I've got to finish on time this week because we are taking Ava to Disney World, to Paris and Epcot, because we promised to take her to Paris, and we always live up to our promises. And when you're 3 years old, Paris and Epcot is pretty close to Paris. I will close with the Charitable Lead Annuity Trust. The estate tax is a voluntary tax if you don't mind giving to charity. So while you're alive or when you die, you leave $1 million worth of assets into a trust. They will grow at 6% a year, and the trust will make 12 annual payments to the charity of your choice, which could be your family foundation. And what's left at the end will pass to your children. So 12 years, charity gets 11 million. It reinvests it, so it's really going to get 15 million. At the end of the 12th year, the children get 4 million, plus they control the 15 million in the charity. Children get 28%, charity gets 72%. But if we use a 12-year CLAT that starts with lower payments and increases the payments by 20% a year, then the kids get 35%, charity gets 65%. If we use a 20-year CLAT with annual equal payments, the children get 45%, charity gets 55%. If we go with increasing payments, the children get 57%. That's almost like the estate tax, except Instead of the 43% going to the government, the 43% goes to charity. And if you set this up while you're alive, you can get an income tax deduction of $10 million. But let's say the CLAT is funded by a discounted North Virginia LLC interest. That's non-voting for those of you people who are from Virginia. Now, look at the numbers. If you go with 20% per year increasing, the children get 73%. Now, they got to wait 20 years to get it, but by then, maybe they'll take better care of their original inheritance. They'll wait the 20 years, plus they could be employees of the foundation that receives the payments. Uncle Sam gets 27%. So I hope that you'll keep charity in mind, give charity a chance with respect to your planning. My final word is if you have a large IRA and you're over 59 and a half, you can transfer the money from the IRA into a charitable foundation, first to you and then to the foundation. Make it a private operating foundation, get 100% tax deduction for 2021 only. So if you've got a $10 million IRA and you want to give $1 million to charity, sometime in the next 5 years, go ahead, take $1 million out of the IRA. That produces income, but then put $1 million into the charity. You get $1 million deduction, and then charity, you could put those grandchildren on the payroll, put your friends on the payroll, have them earn the honest money helping the world. Help the world because we need help. Maybe even help dolphins. So that's it for today. Thank you very much, and let me know what you agree with, what you disagree with, and what we can provide for you in the future. Take care.